Welcome, folks. We'll be with you in 1 minute. Having a few technical difficulties this morning that we don't understand why. So morning, folks. Bear with us 1 second, please. I apologize. I'm sorry, folks. We're just having some technical issues that we're not quite understanding. We're working on them. Bear with us, please. Welcome, everybody. We have a small group today, which is fine. So we are going to open the floor up to any of your questions. And today we are here to talk about the Main Street Lending Program. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in this day, we will also email a copy to all participants. I am the founder and CEO of MultiFunding. I write regularly for Inc. I have a book out called The Growth Dilemma. And for my entrepreneur organization friends out there, I'm a proud member of EO Philadelphia. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future. And we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be thinking about what is next in our business. And this involves our strategy. Will we be pivoting 5%, 50%, or 90%? what will our team look like going forward, and what cash will we use to go into this battle. And cash is both used for offensive and defensive purposes. How much cash will you need to get through this crisis, and where will it come from? What is the best case and the worst case scenario? And as you ponder the future, what does it look like, and what resources will you need to make it happen? These are the questions I wish you to think through as you think about the Main Street Lending Program. It is part of the CARES Act and has $600 billion allocated towards it. It is in effect until December 31st, 2020, and it is comprised of 3 facilities, a new, a priority, and an expanded. Some context is important. This is not an entitlement program like the PPP. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. Most participating banks are up and running. The list of lenders on the Federal Reserve website is not 100% complete or accurate, and the program has been extended until December 31st. You have to think through in the program what the motivation is of the lenders who are participating. If you have an existing relationship with the lender and you have debt with them, it makes complete sense for them to consider adding additional debt to you to give your company more runway and protect your current liabilities. If you have little or no debt, you will likely be looking for a new lender, and these lenders are looking for strong credits and new banking relationships. There are about 400 banks across the country participating at different levels across the program. To be eligible, your business must be established prior to March 13, 2020, and you must meet at least one of the 2 following conditions. You have to have, if you have more than 15,000 employees or 2019 revenue in excess of $5 billion, you're too big. And your business has to be created or organized in the United States and operate under the laws of the United States. Use eligibility test. You need to have 50% or more of your assets in the United States, annual net income generated in the United States, annual net operating revenues generated in the United States, and annual consolidated operating expenses in the United States. Subsidiaries of foreign companies can apply, but they have to attest that they will not send the money upstream. Eligible entities are partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. Sole proprietors are not eligible for the program, and nonprofits are eligible, but under a different program with different rules. Ineligible borrowers include developers or landlords, lenders, and other industries that are considered to be speculative by the SBA. If you are part of an affiliated group of companies and you own multiple entities or control multiple entities, those entities on a combined basis can apply for one of the 3 Main Street facilities and at the max of that facility. So let's dig into the 3 facilities. The first 2 are the new and the priority, and they share some commonalities. These are secured or unsecured term loans. I apologize. They have a 5-year maturity. You don't pay anything in year 1, you start paying interest only in year 2, and then at the end of year 3, you pay 15%. At the end of year 5, you pay 70%. The rates are the adjusted rate of LIBOR plus 3%. So you can calculate 3.31% for these loans. Prepayment is permitted without penalty, and the fees to get in are 2%. The new facilities start at $250,000 and they go as high as $35 million. Let's look at them. How do you calculate how much you might be eligible for? Take a company in 2019 in row 3 that had $500,000 of positive Ebitda. The maximum new loan facility that company could get would be 4 times that, or $2 million. That company had $1.5 million worth of existing debt that would get subtracted from it, and their potential new money loan would be $500,000. If that same company in row 1 had $500,000 worth of existing debt, their potential new money facility would be $1.5 million. What's important about these is that it really has to do with the relationship with your existing lenders. If you're going to keep existing lenders or you have them, they have to agree that for you to get this loan, if your company goes bankrupt while you have the loan, that lender will share the rights. Your existing lenders will share rights in bankruptcy with your new lender. However, the rights in the ordinary course of business do not matter. These loans can be secured or unsecured depending upon what you work out with your lender. Priority facilities go a little bit bigger. They go from 250,000 to 50 million. How do you calculate them? In row 3, you have a company with $500,000 of Ebitda, and the not to exceed is $6.3 million. That company had $1.5 million worth of existing debt. That potential priority facility would be $1.5 million. That company in row 1, if they had $500,000 of existing debt, could get one for $2.5 million. Unique about these loans, unlike the new facilities, you can refinance existing debt into one of them as long as the debt is not with the lender that's giving you the Main Street loan or one of its affiliates. And in these loans, the lender's rights have to be senior or on par with all of your other lenders, except for your mortgage lender. These loans can also be secured or unsecured, depending upon what other loans you have and what you're able to work out with your lender. The expanded facilities are bigger. They start at $10 million and go as high as $300 million. How do you calculate them? Take as an example in row 2, a company with 2019 Ebitda of $10 million. Their maximum Main Street loan facility expanded to be $60 million. But if they had $50 million worth of existing debt, they could get an expanded tag-along facility of $10 million. These work in a very similar way to the other loans, except they tag-along rights with the existing lender, and the fees to get in are a little lower. On all these loans, you cannot, unless you're refinancing debt at the time of the loan into the priority facility, you cannot repay other debt earlier while you have the loan. In addition, you cannot seek to reduce or cancel any open lines of credit, and you have to certify that you have a reasonable basis to believe that you meet your financial obligations for at least the next 90 days and have no reason to believe your business is going to go bankrupt. While you have the loan, you can repay a line of credit in the ordinary course of business, including a credit card. You can take on additional debt as long as that does not interfere with the rights of your Main Street lender, and you can refinance maturing debt. There are certain certifications and covenants you have to be concerned about, specifically around compensation, stock repurchase, and capital distribution restrictions. There are exceptions for S corporations or other tax pass-through entities in order to meet your tax obligations. While you have the loan, you agree for up to 12 months after the loan, and for up to 12 months after the loan is full, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earned between $425,000 and $3 million in 2019, you agree that you cannot earn any more of that while you have the loan plus 1 year thereafter. Those who earned in excess of $3 million, say you earned 6, what you do is you take the delta between 3 and 6, 1.5, you add that to the 3, and your compensation is $4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan, but unlike PPP, the primary emphasis of this is saving the company, not saving the jobs. If you're going to a new lender, they will need to calculate your Ebitda or any adjustments you want to be considered in a way that they've done it with similar companies like yours before. If you're going to an existing lender, they will have to calculate your Ebitda in the way that they've worked with your company historically. Your debt, for the purpose of figuring out how much you can borrow, will be counted on the date of your application and will include drawn and undrawn debt from private and bank lenders. If you have an asset-based line secured by accounts receivable and inventory, the amount of your debt will be what you actually have borrowed on the date of your application, not what you could borrow. How do you pick between the new, the priority, and the expanded? Well, some of it depends on your situation and what your needs are and what you can work out with your lenders. So, as an example, a company with $4 million of 2019 Ebitda and $10 million worth of existing debt could get a new facility of 6, a priority, or an expanded facility of 14. How do you think about all this? Financing strategy is both offensive and defensive, and there are different scenarios that I'll share with you that borrowers are thinking about this. One is that company with a $3 million line of credit and $1 million drawn. They are planning on getting an MSLP to add additional liquidity. They would rather not draw down their entire line during the epidemic. Another example is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And finally, is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will be required to get your business back on the stable footing? What is the best case and worst case scenario? Where will the cash come from, and how will you fund it? And as you look into the future, and you might not be able to see it all, what will your cash needs be going forward? That is my end of my prepared remarks on the main street. And now we're going to welcome anyone who wants to share your questions in the Q&A, and we'll be happy to take them. Also, because it's a small group, if you want to raise your hand, we'll be happy to do that. Feel free, folks. We have a very quiet group today.
Are there interest payments for the first 2 years, or is this deferred? If I'm understanding correctly, we can take Main Street and then fold into a SBA before the balloon?
So there are no payments. Interest accrues on day one. There are no payments in year one, but you start making interest payments in year two. And that is correct, that you could fold it into an SBA before the balloon, but that's under the assumption, that's not a predetermined conclusion. You have to wait to, you'll have to assume that either your existing lender or a new lender would give you an SBA loan at the time. You can't assume that you'll automatically get an SBA loan.
Has any of your customers been funded yet?
We have two literally just waiting for a final signature. The loans have to be approved at the reserve and the documents before you do them. Two of them are in at the Federal Reserve, and we're just waiting, and plenty of others are in queue. Happy to take any other questions, folks.
With your customers, are lenders willing to make MSLP loans if what it is to be purchased has not been identified?
Yeah, we have lenders who are willing to do that, but some of them are demanding that the money sits in escrow until the acquisition has been identified. So they hold it in an account at their bank that accrues interest on your behalf, but they're not actually releasing the acquisition funds until such time as it's been identified. Happy to take any other questions.
Have borrowers been able to get 6 times their cash flow?
Nothing close. The highest we've gotten, I think, is 4.5 times cash flow. And I haven't heard of anyone in the market, at least for a new customer, who's been doing 6. They might be doing 6 if it's a lender worried about their existing loans with you and they want to protect them. But for sort of new loans, we haven't seen any of that. I think we had someone raise their hand. Did we see that? Maybe not. Happy to take any other questions or thoughts. See some questions about PPP forgiveness. There's some new guidance out this week on PPP forgiveness. To be honest, I haven't had a chance to go through it yet. I hope to do that this weekend, and we'll probably put a PPP forgiveness updated Aminar on sometime next week. Happy to take any other questions, folks. Okay. I think we're going to wrap up for now.
There's a question in the chat. What secured loan means personal guarantee?
So in 99% of the cases, it's two different questions there. Everyone should be clear that in 99% of the cases, we're saying the lenders are demanding personal guarantees on Main Street loans, which means the lender can come after you personally for it if the loan doesn't work out. That's the number one thing. Secured means that they're going to take liens on assets, either personal or business, in order to protect their loan in case you default. Any other questions, folks? Okay, we're going to wrap up. We wish everyone a good day, and we'll be back online next week. Take care, everybody. Bye-bye.
Thank you.